Hey everybody, Ryan here. So Bank of Canada raising interest rates again, another 0.75% today. To be honest, we were kind of expecting this, not something that's totally off our radar, not something that we weren't really anticipating. And to be honest, my best guess as of going into this yesterday was going to be for a 0.75% increase. Now, do I think this is any reason to panic? No, I don't honestly think so. I think that this is something that sort of has to happen in the grand scheme of things. What we're still seeing with inflation is it is way higher than the Bank of Canada or the government wants it to be right now. And so raising interest rates is just one of the tools they've got in their toolkit to try and solve this problem and get inflation back down to where it should be. Now, I say don't panic, but I always think it's pretty important to give people the reason behind that and sort of give you guys some feedback on why I don't think we should be panicking. So here's some of the things to consider. Timing of all of this. This is really quite important, I think, is rate hikes, the impact that they're going to have on the economy. This doesn't happen overnight. Takes typically 3 to 6 months before we start to see that there's a real impact from a rate increase like this. So what that tells me is that we still haven't really seen the impact of the rate hikes that Bank of Canada did back in April or May, let alone the big supersized hike we got in July this year. We're still really waiting to see how those things impact our economy. I think the July inflation reports show us that there's been a little bit of impact. Headline was that a lot of that has to do with gas prices and oil. So, good news is at least that's coming down a little bit. Some of the other stuff has stayed high. But where I'm going with all this is I honestly expect that we're probably going to see it takes till December this year at minimum before we really start to see the impact of these rate increases. So, up until we hit the end of this year or into spring next year, even as late as February or March, we're not really going to see this have a big impact. It's going to be at the end of this year or into spring next year that we start seeing those inflation readings coming down, and that we start to see that, in my opinion, and same, with a lot of the economists out there, I think we're overshooting. I think Bank of Canada is taking rates too high. And then what's going to happen is we're going to overshoot. They're going to find that drives the country into a recession. People stop spending. Worse yet, they lower their spending to the point where the economy actually contracts, gets smaller. When we get there, really one of the best tools in their toolkit to fix that problem and resolve the recession is to lower interest rates. So we're going to see this big steep curve up. Rates are going to hit this ceiling sometime towards this year, end of this year. Maybe this is it. We don't know. It's going to take a while before we know that. But when we do hit that peak, it's pretty likely we're going to be in a recession, and the Bank of Canada is going to lower interest rates to try and balance things out and get us back to sort of a normal growth rate. Ideally, what the Bank of Canada has told us historically is that they want this overnight rate everybody's going to be talking about today to be somewhere between 1% to 2%. If the economy is doing what it's supposed to, if inflation is not going crazy like it has been this year, then that overnight rate should be somewhere between 1 to 2. Right now, it's 3.25, and it is very likely that before the end of this year, it might be even 3.75 or 4%. So it is a lot higher than it normally should be or normally will be. What that tells us, and sort of what the economists are saying right now, is that once we hit that peak and we do see inflation come down and we do land in a recession, we're going to have the Bank of Canada lower that overnight rate somewhere back into that 1% to 2% range. I think it's reasonable to think it's probably going to level out around 1.5%. Maybe it's a bit higher, maybe it's a bit lower. But if that's correct, if we land in that normal overnight rate range, that means we're going to see today's interest rates come down by 1.5%, maybe nearly 2% from where they are right now. The reason I think that's important is for everybody that's in a variable rate mortgage right now, all of us, myself included, obviously feeling a bit nervous, wondering, is this the 80s all over again? Is this what our parents were telling us about? Are we going to see our mortgages become 18, 20, 25%? Not very darn likely. Sure, possible, but not likely. What I think is likely to happen is we'll hit this peak. If we haven't already, it's going to be very soon. We're going to see that rates settle out into this normal overnight rate range. And that if that happens in the next 12 to 18 months, that's going to give variable rates the edge again. They're going to go up quite a bit, then they're going to settle down at a more normal level. And if that's right, if we're correct about that, they're going to have that significant edge that they have over fixed rates. So, that's why I keep telling everybody, if you're in a variable, if you're still comfortable, if you're sleeping well at night, don't convert it. Don't switch it to fixed unless something in your life has drastically changed. Mostly because converting now means converting to these elevated fixed rates. It's a little late for going back to 2021 and taking those magical super low fixed rates we used to have. If you're going to convert your variable now, you're going to convert it at 4.5% or 5.5%, and you're going to lock it there for the next 5 years. Well, if your variable is at 4% right now, and we think that maybe a year or 18 months from now it's going to be back down to 3% again, why would you lock it in at 5 right now? That doesn't make a lot of sense to me. Obviously, everybody's situation is unique. It's got to make sense for each person. And, that's why there are so many people that will opt for a fixed rate. They're willing to trade off that, advantage in interest rate for the security, the insurance policy of knowing their payments are going to remain stable. But on the flip side, if you aren't comfortable, if you're in that variable rate right now and it's really keeping you awake at night worrying about what's going to happen in the next year or two, then there are options. We can look at that conversion to a fixed rate. For some people, that's going to make sense. We can talk about refinancing. For a lot of people, that's going to be one of the best options right now, is extending that amortization out, driving those payments down, getting them to a level that you're comfortable with so that you can ride this out. Maybe getting rid of some other debt. For a lot of people, things like car loans or credit cards have been piling up. Inflation especially, it's getting to all of us. So, cost of our grocery bills, a lot of people are throwing that on their credit cards. Cost of a new vehicle. Some of us have been waiting a year or two for a new vehicle to roll in. It's finally here. Now we get a big fat payment to go along with that new car. A really good resource right now, or a good tool we've got available, is to use the equity that's in these homes. For a lot of us, we've made several $100,000 being homeowners as Canadians over the last few years. So if you're one of those lucky people that's owned your home for a couple of years, now might be a really good time to think about rolling in some of that debt. Credit cards, car loans, personal lines of credit, anything that's hanging on that you're really not getting ahead of, now's a very good time to roll some of that stuff in, get rid of those other big payments, consolidate it at a lower interest rate, and really just simplify your finances a little bit so you're getting ahead, making some repayment on those different debts each month. But like I always say, if you are at all concerned, shoot me a message, give me a phone call. I'm always happy to chat with anybody that needs to. And if you are in a variable rate and you're comfortable riding this out, all signs are pointing to this being at or near the peak. Hold on tight for another year, and I do think that we're going to see some savings for everybody that's in variable. Not anytime soon. It's going to take us a little while to get there, but I think if we look back a few years from now, there is going to be a long-term payoff sticking it out and riding out that variable rate if you can weather the storm. And again, if you're nervous or something's not feeling right, or you just want to talk about it, give me a call or reach out. I'm always happy to make time. Thanks very much, everybody. Have a great week. Bye for now.